Country has elected a new president, and the Fed continued cutting rates, this time only a quarter of a point. If you need help navigating all of this, you can head to wealthion.com/free for a free no obligation portfolio review. I'm your host, Andrew Brill. With all that going on, let's get to the recap and see what our experts had to say this week. Chris Casey of our partner RIA Windrock Wealth Management joined us after we knew who the next president will be. He explained the difference between tariffs and taxes. He also touched on other countries reciprocating if the president-elect imposes tariffs, and they will negatively affect prices. Chris believes the country will move in the right direction financially over the next 4 years. He also feels that the Fed cannot so easily be reshaped. So, Chris, you mentioned tariffs. Explain to me tariffs and explain to our viewers tariffs versus taxes. A tariff is, in essence, a tax. And I know that Donald Trump said, oh, China will pay the tariffs. China isn't really paying the tariffs, are they? It's the importers into the United States who are going to pay the tariffs.
Yeah, I think I said this last time, and no tax is neutral and doesn't create misallocations, doesn't cause distortions, doesn't cause, frankly, a reduction in the standard of living, all things being equal. But I would say tariffs are a little bit more benign than compared to a lot of different taxes out there. In fact, I believe for last year's budget, for the fiscal year for the federal government, which ended September 30th, I believe the tariff income or revenue was around $80 billion. And that's just a drop in the bucket compared to when you have $5 trillion in revenue, right? It's fairly small. So there's a lot of room for that to grow going forward.
And these tariffs, do you expect countries any country that's imposed a tariff upon, say, imports coming in from China, imports coming in from Germany, imports coming in from anywhere, Trump is promising a tariff. Do you expect those countries to reciprocate and say, okay, you want to put a tariff on our goods, we're going to do the same to you?
That's quite likely. I mean, we've seen that recently with China and the European Union. I can't recall what the European Union put some tariffs or quotas on, but China immediately retaliated on, so I believe, some luxury goods. So it's not even necessarily the same industry or the same good that's affected. They retaliate in different ways. So that, I think, that is likely. Now, I think that would be a poor decision on the part of any country doing that, because I strongly believe in free markets and free trade. So theoretically, I'm against tariffs. However, not every country feels that way, and so I think they would view it as quid pro quo. It's their way of potentially reducing tariffs in the future. But in reality, their country would be better off if they did not retaliate. And just, yes, it's bad that there's tariffs being placed on exported goods from the foreign country, but retaliating would just make things worse.
But that tariff is really going to be passed on to the American people in the form of a higher price, because the tariff is going to have to be paid by whoever's importing that good. So ultimately, it's the American people paying that tariff.
Yeah, any consumer, ultimate consumer. We're not always talking, obviously, about retail goods. So there's companies that are buying imported items as well. Yes, the consumers in general, tariffs, do have a negative impact. Now, whether that eats in the profits, or there's increased prices, or there's less capital expenditures by these companies, there's a whole different ways it could play out, but they're all negative to a degree.
Can you? I know you've looked over Trump's economic plan. Can you go enlighten us a little bit on how you think that he's going to help the country?
Well, I think even better than looking at any kind of proposed plans, because there's a lot of things he's promised and said over the campaign, would be to look at what he did before. So one of the first things he did back in 2016, by I believe December of that year, you had what passed as the Tax Cuts and Jobs Act, which massively reduced taxes, especially on the corporate level. And I think we'll see something akin to that again. That's one of the major benefits I could see coming out of this administration. The other, and I thought he did a great job of this last time, it's probably one of, I'd say, the top three things I thought that former administration did under Trump. But the other item is just deregulation. And you may recall he had that policy in the first term of, for every regulation we have, we're going to rip, I believe it was 3 out of the books, right? We're reducing regulation for every new one that's introduced. I love that idea. And now that Elon's on board, and he clearly, whether he's looking to cut wasteful spending or whether he's looking at just cutting regulation, I think if anything, that'll be more pronounced at this go around.
Obviously, a new president comes in January 20th. Interestingly enough, that's Martin Luther King Day. So you have Donald Trump being inaugurated on Martin Luther King Day. And so the Fed will have another decision to make. I guess they'll see what President Trump does in his first few days and act in kind, or do you expect more cuts going down the road? I know that they talked about, maybe bringing rates down to 3% or 3.5%. Right now they're hovering around 4.75. That would be another point and a quarter. But if we're talking about another 50 basis points, we're down to about 4.25. Do you think the Fed will say, you know what, let's pump the brakes and see what we're going to do now?
Well, as the Fed always says, they're data dependent, right? They say that each time. And
whether we believe that or not.
Well, I believe it because the way I interpret that is that they're extremely reactive, right? Because they really are. They're just constantly reacting to new stimuli that's put before them. That's really what they're doing. I don't think there's an overall game plan. There's certainly no philosophy underneath it. I guarantee that. As far as what they do next year, I think it's highly dependent on the markets. So let's just see if there's a financial downturn, let's say the first quarter, if the economy, which I do think will happen, if we start to experience weakness or recession, they'll go right back to the same playbook and all bets are off. Then they could cut quite a bit. What I do know, though, is that Trump has very limited ability to reshape the Federal Reserve Board. There's 7 governors, right, that voting governors. And there's only 2 that have terms expiring during Trump's term. And they expire fairly late in the term. I think one's even like towards the end of 4 years. Now, Powell does have his chairmanship come up, I believe, in May of 26. And Trump has already been on record that he won't, Powell still be on the board. He just wouldn't be Fed chair. He's not going to renominate him. So we'll see what happens. But again, the point being is that the Federal Reserve policy, I think, will continue intact. I don't even want to call it policy. Let's call their reactions will remain intact for the foreseeable future because that board is not going to change.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family. Speak Up, welcome back David Lynn this week. He touched on the steepening of the yield curve and the concern about the rising debt. He also explained why he thinks DeFi is a thing of the past, but crypto and Bitcoin have a lot of room for mass adoption. So you've interviewed, and like I said, on your channel, you get phenomenal guests. You've interviewed many influential figures in finance. Are there recurring themes or trends from these conversations that stand out as essential to investors that they should consider?
Yeah, I think the trends change depending on when we're having this conversation, right? So right now, I think 2 interesting trends come to mind. One is that you have the steepening of the yield curve at a time when the Fed just cut rates by 50 basis points. So the 10-year yield is rising faster than the 2-year. And it's not common that we have the long end of the curve rising this much immediately after a Fed cut. Actually, I think it was Jim Bianco who tweeted this recently. I've had Jim on the show a couple of times. He's great, Bianco Research, but he's tweeted this recently, and he said that never before have we seen the 10-year yield rise this much after a Fed cut. The 10-year yield's also been following well, I don't know which following the one or the other, but coincidentally rising along with the 10-year break-even inflation rate, which is the expectation for the inflation rate going up. Now, that's unusual because the inflation rate, as you know, has been going down. The latest reading was 2.4%, down from the previous month, and that's just been on a continuous downward trend ever since its peak at 9.1%. And so, with the actual CPI inflation rate going down, inflation expectations are going back up, which is something of an irregularity. Uh, the inflation break even typically has a lead over the actual inflation rate, so it wouldn't be surprising to see inflation rate stabilize around here if you assume that the expectations are going to be correct. Also, if you overlay the U.S. dollar with the 10-year yield, it's been a perfect correlation all year round. Now, all these forces have meant that if you look at some of the asset classes that traditionally have not been correlated with each other for a significant amount of time, they have. So the dollar has moved in tandem with gold in the second half of the year. It's also gold has also moved in tandem with stock markets all year round, and Bitcoin has had a great year as well. The last time we saw major asset classes that typically don't move together was back in 2020 when the Fed launched unlimited QE, and so there was monetary stimulus, money injection, and so all asset classes moved together. Monetary stimulus from the Federal Reserve was the tide that lifted all boats. We're not seeing stimulus on the same level again right now, but we are seeing rates starting to fall. And it's just interesting how asset classes have been rising together all year round in anticipation of this. So that I think that was one of the irregular trends. What this means for investors is that we have to be aware of that. Um, not all asset classes that have historically moved in opposite directions are going to stay moving in opposite directions, likely into 2025. For example, if you assume that gold typically hedges against equities, well, that hasn't happened all year round. And so that may not happen again in 2025.
And doing what you do and doing over your interviews, you've heard what Tudor Jones has said about the debt. You've heard what Stanley Druckenmiller has said about the debt, that they're very concerned about the debt load.
Yeah.
I you know, where, other than cutting spending, and it's interesting that I interview people probably like you do this. Oh, it's not a concern, like you've done already. It's not a concern, but it is a concern, isn't it?
Well, I think Paul Tudor Jones and Druckenmiller know a lot about the debt levels and the economy than I do. So if they think it's a concern, it's probably more of a concern. They're probably concerned about it in other ways. I mean, to the extent that the country's going to default on their debt and roll the markets right away, no, that's not a concern for me. Again, long term sustainability wise, um, it's a concern to the extent that the government will have to reallocate their budgets to be able to afford that. How it impacts the markets is a question I ask many experts because I don't really know the answer to that. Certainly, the debt to GDP level has been rising. The deficit has been widening, yet the stock markets continue to go up. There is no direct correlation between stock market performance and the deficit level rising, at least not in modern times. The only time in the last 70 years, I believe, in which the government actually balanced their budget was during the Clinton era. And, that was early 90s. So the stock market did fine then. It's doing fine now when the deficit level is at the widest since World War II. So there is no direct correlation between the deficit level and the stock market. Whether or not there's a correlation between debt and 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 the markets, I think the missing link here is inflation. If you believe that the Federal Reserve is going to monetize some of this debt, which is to say they're going to buy up some of the debt and issue money to do so, there might be an expansion in the money supply. And if you're a monetarist, you might believe that this expansion in the money supply will lead to inflation. Inflation is related to markets, as we know. Markets
Mhm.
don't like very high inflation, and certain asset classes will respond in kind to this inflation. So yes, higher debt levels could have indirect uh, effects on the markets through the transmission of inflation of certain assets.
I want to get into some of your interviews you've done about crypto and DeFi, and I know that you have spoken about this a bunch. You've covered it, the influence of it all, and blockchain. How do you envision these technologies, crypto, blockchain? How do you envision them changing the landscape of traditional finance? In the near future, a decade or so.
I don't know. Is my short answer. I
That's
don't know what DeFi is going to look like in the next. Because look, I'll tell you, DeFi was the hot buzzword in 2021, and most of these projects just died. So back then, people were promising the entire world to be revolutionized by DeFi, and maybe it still will be, but like 90% of the industry is just dead because there was a huge bust in the crypto markets, as you know. 99% of NFTs fell to zero, and a lot of these crypto projects just didn't survive. How will DeFi change finance? Well, it's really up to. I think a catalyst for mass adoption could be one day if traditional banks start to issue cryptos, either as a payment rail or as just accepting it as a transaction, or if you could invest in Bitcoin with your local JP Morgan Chase or something, that could really open up adoption because it would make it easier for people to adopt cryptos. So if the regulatory landscape were to change such that big banks can start offering that, I think that could really open up a lot of doors for crypto. As for DeFi, which is really the antithesis of traditional banking, so the opposite of what I just said, um, that's more of a B2B issue.
Mhm.
So if companies want to transact B2B using some sort of crypto, there's always going to be a need for an intermediary merchant that can help facilitate that. It's interesting how the DeFi world is kind of evolving into TradFi, except using cryptos. You have all these intermediaries doing payment systems, B2B. Well, that's just a bank, isn't it?
Right.
So I think DeFi is becoming more of a misnomer because it's really just blockchain finance, and there's nothing really decentralized about a lot of these products. But Bitcoin, I think, still has a lot of room for mass adoption.
John Ciampaglia, the CEO of Sprott, joined Wealthion this week and explained what the driving force is behind gold. He's also seeing an influx into silver, and uranium has been a popular investment despite only two major producers of it in the world. John also touched on big tech and how they are getting into uranium.
And of all those different metals that you just mentioned, which one has had the best performance this year and maybe the most flows from investors?
Yeah, so obviously it's been a year for precious metals. They were clearly in the doldrums last year. They seemed to wake up late, about 12 months ago, actually in October of 2023. Gold kind of hit $1,800 an ounce, and we've obviously had a really great rally up to 2,700 and change per ounce. So gold has been the attention grabber for sure in the last 12 months. Silver technically is outperformed it a little bit, but I think gold has really been part of the conversation because of a number of really interesting developments. One, central banks are increasingly shifting their foreign exchange reserves away from US dollars and other currencies and treasuries to gold. That's a very interesting dynamic that we think will play out for many decades. It's not just China, it's India, it's Singapore, it's Turkey, Poland. They're all adding to their gold reserves, and that's, I think, provided a lot of durable buying support. But we also see institutional investors coming back to gold in the last 2 months after largely ignoring it for the previous 10 months. So that's a very bullish sign. And then finally, I would say Chinese retail investors, which obviously provide an enormous amount of collective savings. They've been coming back to gold. And the reasons we think are their economy is sputtering. Their real estate market has clearly been in a bubble for some time and has popped. And their equity market has performed very poorly. And so when you have very limited options to invest in China, gold is kind of reasserting itself as, kind of a tried and true asset. So we're seeing a lot of retail investors in China starting to buy little quantities of gold again. I think all these things are really helping propel gold to new highs of late.
And I do want to ask you about some of those other metals associated with electrification. But before I do that, I want to stick with the precious metals. And silver is also having a very good year. It's up around 35% on the year. Maybe you can just speak to the flows you're seeing in those products.
Yeah, we've definitely seen some inflows into silver products, including our own, over the last few months. I mean, it is a much smaller market than gold. I mean, gold is one of the most liquid currencies in the world. Silver is a much smaller market because of its value and just sheer size. But what you're seeing is silver is really benefiting from its dual role as a monetary metal and also as an industrial metal. And so investors typically will hold silver as a hedge against risks or an inflation hedge, or in many cases in emerging markets where gold becomes too expensive for them to buy, they sometimes transition to buying silver as a substitute. We see that right now happening in India. So more and more people are buying silver in India than gold because of the price differential. But silver is also a beneficiary of a growing number of clean energy technologies that are very silver intensive. The most common is obviously solar panels, because silver is so conductive in terms of exciting electrons in those panels. They essentially create a silver paste that they put inside these solar panels to make them more efficient. And as the world is deploying record amounts of solar panels because the cost of them have collapsed over the last few years, more and more demand for silver is not going for investment purposes or medical uses or whatnot. It's going specifically for solar panels. And what you find is that at the end of the life of those solar panels, which might be 20 or 25 years, it's very hard to recycle those metals inside there. So it generally gets wasted. Unlike other metals, there's a lot of value in them. There's a lot of effort to recycle those metals. We don't think a lot of that silver is going to come back to the market. So it's essentially used and consumed forever.
So let's move on now and discuss uranium. And I'm sure you would agree with me when I say no other commodity has such a positive backdrop as uranium does. But this isn't really being reflected in the price or in the equity prices. And why don't we just first start with the spot price? Maybe you can give us some color. How many pounds have traded this year, and how does that compare to last year?
Yeah, sure. So the uranium market's been a bit of a head scratcher this year. Last year, we had a huge breakout in the price where we ended up 2023 at a price of $91 a pound in the spot market, which was up 89% for the calendar year. So it really broke out on very strong fundamentals, increased, shift back to nuclear energy in many countries, and coupled with supply challenges. A lot of mines that have restarted have had some production hiccups to start. And the world's largest producer in Kazakhstan, finally acknowledged in August that it was not going to be able to meet its higher production targets that it had given a year earlier. So we've got a growing demand profile. We have a kind of choppy and somewhat, uncertain supply outlook. And yet with that backdrop, the price of uranium has gone from about $91 at the beginning of the year, as I mentioned, to right now we're sitting at about $80. And so people are kind of questioning, okay, with this very bullish backdrop, why is the price corrected? And we think there's a few factors obviously at play. We think that one, I think it's a natural event to have a bit of a healthy correction as part of an overall bull market. We see that all the time where commodity prices can go up hundreds of percent over multiple year bull markets, but along the way can have many 30, 40% corrections, which, can shake out investors. So yes, we've had a bit of a correction right now, but we also think that the primary buyers of uranium, which are utilities, have been distracted by a lot of things this year. One, the United States banned the importation of Russian enriched uranium. That became law in August, and that created a big distraction. There are waivers that are being granted for a period of time where a utility can plead their case to the Department of Energy to say, look, I don't have an alternative supplier, so I need to continue to take these deliveries from Russia. Those are just starting to be given out, but only for this year and next. So there's some uncertainty about what happens after that. Putin has threatened, like palladium, to cut off the West from uranium in retaliation for all of these sanctions. So there's been a lot of noise, geopolitically and from a regulatory perspective. And utilities, I think, have really stepped to the sidelines and have not procured as much uranium this year as you would think they would. And we see the volumes in the spot market come down significantly. The volumes in the term market, while they've started to pick up in the last month or so, it's all been China driven. So China continues to accumulate large amounts of uranium because they are building the most number of new reactors in the world, and they're very smartly ensuring they've got their security of supply with fuel to meet their future needs. But we get the sense that Western utilities are sitting on the sidelines with the belief or the hope that prices will come down. And so they don't have to buy immediately. They can wait the market out. And it seems as though we have a bit of a stalemate between sellers and buyers. And, the sellers have largely sold production forward for a number of years. So they're not in a rush to lower prices or sell more because they've sold a lot of material on forward contracts. And, it's getting harder and harder to bring new production online. The buyers are clearly of the belief that prices will come down. So, be patient. And, it'll be interesting to see how this goes. But at the end of the day, I think it's fair to say that you can delay and defer your purchases, but at the end of the day, you need to buy because, fuel is absolutely critical and there's no way to substitute uranium for something else like you can with other commodities.
And who would be the top 3 producers of uranium in the world?
Well, this is the interesting thing about it is that there's really only 2 big producers in the world. And so if you think about a critical mineral that produces 20% of U.S. electricity, 10% of global electricity, you've got basically 2, companies that produce the vast majority of it, which is one is a state-owned company in Kazakhstan called Kazatomprom. The other one is a Canadian company called Cameco. Those 2 companies are the largest producers of uranium in the world. There are a number of producers that are at much smaller scale that are either in the process of restarting old mines that have been closed when the price of uranium was, $30 or less per pound. Now that the price of uranium is sending out the right signals and there's improved demand, those owners of those mines are slowly turning them back all online. We've seen a number of mines come back to production this year and many more that are working on coming back into production. And that's why the equities in the uranium sector, I think, have performed really well. If you take a step back and look how they've done over the last 4 years, they are more volatile because they're smaller cap companies, many of which are just, getting back into generating cash flow. But the stocks have done very well over the last 4 years on the back of these improving fundamentals and obviously improved uranium prices.
So there's been so much big news coming out this year on nuclear energy and by extension uranium. And I guess the most recent news is just the emergence of big tech into nuclear energy. Maybe you can speak to that.
Yeah. So in the last few weeks, there's been a lot of exciting news developments and announcements related to big tech. So big tech kind of covers, Microsoft, Amazon Cloud, Google, Meta, Apple, and Oracle. And they're all kind of following a similar strategy, which is they need to source large quantities of electricity and preferably clean, meaning no greenhouse gases or low greenhouse gases, and preferably firm. Firm meaning the electricity source runs all the time or provides electricity all the time versus variable or intermittent energy sources like renewables. And they're doing this because they are all developing a technology and they're all in a race to be leaders in artificial intelligence. And why this is so linked to electricity is because the data centers that run these essentially supercomputers that do this artificial intelligence are incredibly electricity intensive relative to traditional data centers. And some estimates I've seen are 7 to 10 times more electricity intensive than a typical data center that we would use for, surfing the web or, loading photos up or whatever. So it's a race to be a leader here. And what these technology companies have figured out, that one of the biggest obstacles is not the technology, it's sourcing the electricity. And that's because, if you look at the US grid, for example, load growth on it for the last 20 years has been almost zero. And so we haven't had a lot of energy addition. We've had a lot of changes in energy mix, but overall, the load growth has been largely static. Now you're seeing these big tech companies signaling to their local utilities, hey, we need a lot more electricity. I'm just going to put this into context. The let's pick on Microsoft for a minute, because they're obviously one of the leaders of AI in the world. They currently have 19 gigawatts of electricity contracted, mostly renewables, to power its AI data centers, and has another 10 gigawatts of electricity to be built, mostly with the partnership they signed a few months with Brookfield. So, you might say, okay, well, what does that equate to? Well, that's an enormous amount of power. That is the equivalent of powering millions of homes and businesses each year. So they have an incredible appetite for more electricity. And what they're doing is they're approaching utilities and they're signing power purchase agreements, which are basically agreements that say, look, if you provide me the power, I will be your fixed customer for the next 20 years, and we'll agree on a price. And that price that these big tech companies are willing to pay is materially higher than the current prices of electricity. And so the one that caught everyone's attention a few weeks back was Microsoft signing a deal with Constellation Energy, which is a U.S. utility that operates the largest number of nuclear power stations in the country. And they signed one of these 20-year power purchase agreements, and they're going to restart a nuclear power station that's been closed for 5 years. And that has never happened before. A plant closing and 5 years later saying, we need this power, we need this clean and firm power, and we're willing to pay for it. And since that announcement, a whole handful of other tech companies have made similar announcements, not about restarting existing or shuttered power stations, but signaling that they would be financing the construction of a number of small modular reactors, which are smaller scale nuclear power stations, specifically to provide power for their AI data centers. So this is kind of a new case study or use case for nuclear power and big tech. And why everyone's excited about it is because big tech has big money. They're sitting on massive hoards of cash, and they have the ability to finance these, in some cases, first of a kind technologies that utilities may be reluctant to take the financial risk to build these new technologies. So in the absence of government capital or a centralized government, power generation model, it's very important to get outside capital coming in some cases with government money and assistance, to really start building more capacity. And that, is not going to impact the demand for uranium today, but in 5 years from now, 10 years from now, and so on, if this becomes an option that really scales and grows, you could see a new source of uranium demand that even a year ago, nobody really thought about.
On election day, Anthony Scaramucci joined us. He spoke about the market rally that took place. He also touched on the debt and how that may have affected the election. He also explained why the corporate tax rate is lower than some pay on our personal taxes. Anthony, what does it mean that the stock market today is up? Dow is up about 400, NASDAQ up over 200. Any meaning to that?
So I think it's a little bit of a snapback rally. The market has been soft the last couple of days. Crypto market soft the last couple of days. Traders will say that's an indication that Trump is winning. I think Wall Street generally, the consensus is that Trump is winning. The predictive markets have him winning. And and Mitt Romney was quote unquote winning. And even though the polls were statistically tied, those margins of errors actually broke for Barack Obama. He won sort of 53-47. But, Wall Street's saying that he's going to win. Now, um, you know, Stan Druckenmiller had a good point. Wall Street's generally been right about these things. They get a lot of information. Thousands of research analysts are calling through this data. And so, if you were looking at Wall Street, you're saying Trump's going to win. If you're looking at her field operation, you're saying, wow, she's going to win. And so, again, it's still a toss up. But I do think that the market, is sort of telling it's 50.1 Trump, 49.9 in terms of the chances for Harris. I do think that looking at those numbers, again, being as objective as possible, you'd have to say that's a positive sign for Donald Trump.
Yeah, but if a couple people are not feeling well and don't get to the polls, that could swing either way because it's that close. You brought up Stanley Druckenmiller, and he's very concerned about the debt and where we're going. Both of these candidates are going to add to the debt. Different ways, of course. Trump is talking about tariffs. Kamala Harris talking about cutting taxes for the middle and lower classes and trying to, make up the difference other ways. Where we sit on the debt, Anthony, and how do you think this has affected this election?
So it's interesting. So I had a debate with Vivek Ramaswamy this morning on CNBC, and he and I are going to be in violent disagreement about the tariffs. He says that Joe Biden left every single tariff in place. That's factually inaccurate. He left some strategic Chinese tariffs in place that were related to protecting some industries and related to our national security, but he did not leave every tariff in place. And so you have to use the tariffs in a delicate way. You don't want to touch off a global trade war. We certainly need to protect our industries. But one other big thing and one other big negative, if they go hog wild on the tariffs, you're going to have a wipeout of disposable income for middle and lower income people. So Elon Musk is telling people quite honestly, sort of, Elon is not a politician. He's many things and arguably one of the most successful people in the world, but he's not a politician. He's saying, we're going to put in these measures with the Department of Government officially. There'll be 2 or 3 years of catastrophic economic activity in the United States. And so I can tell you that austerity is never the right thing to do for a government that has 25, 26% of the GDP. I can tell you that if we took Elon Musk at his word and we took Donald Trump at his word, we're going to go into a depression, because if you're going to cut $2 trillion of spending, first of all, I don't even know if they could legally do that based on the obligations that they have in terms of these entitlement spending. But you're going to cut $2 trillion in spending. You're going to take tariffs up to 300%. As the vice president pointed out, that's generally a sales tax on lower and middle income people. And then the third leg of the stool economically is you're going to deport people. So as I pointed out to Vivek this morning, you want to deport 2 million people? Okay, that's going to cost you $88 billion. You are going to have to put them in camps. You'll have to concentrate them in camps. You'll have to drive around in our cities and SWAT teams and pull these people out of houses. And that'll hurt our tax base. It'll hurt our GDP. It'll hurt our contributions to Social Security. So if you want to do all those things, okay, but you're calling for a massive economic depression if you do all 3 of those things. So I like her plan better. Lots of economists, maybe there were 24 Nobel Prize winners, said her plan reduces the deficit. At least deficit's growing, but it's going to come down as a percentage of overall GDP. Her tax rates are a little higher. There's no question about that. Nobody obviously wants to pay higher taxes, but can't do what we're doing now. You've got lots of deficit spending. And Andrew, that's unfunded tax liability. So you're going to pay it one way or the other. You're going to pay it in terms of the monetization of the debt through inflation, or you're going to pay it through the actually having to pay it, meaning to the taxman and the IRS. So one way or another, we have to pay this stuff. You can't be in a position to overpromise the electorate like we've been doing, which has been very damaging to living standards.
Went through the economic plans, Anthony, and something really, really struck me. We have a corporate tax rate of 21%. Donald Trump wants to lower it to 15%. Kamala Harris wants to raise it to 28%. Before Trump took office the first time, it was 35%. They brought it down to 21%. Now, corporate tax rate at 21%. I looked at individual tax rates. For a individual that's making $100,000, they're paying 24%. And for a married couple, they're also of 200,000, they're paying 24%. So the individual is paying more than the corporate tax. Anthony, how is this fair? I'm working for the government. I'm paying over 51% in tax because I live in New York. The taxes are high. You live in New York. It's crazy. How are individuals paying more money than corporations?
Well, again, I think one of the corporations would push back and say, don't judge the corporate tax versus the individuals, judge it on a global basis. And let's look at where corporations are taxed around the world. And where does the United States rank in terms of where those corporations are taxed? At 35%, we were ranked lowest. At 21%, we're at the top now, meaning we have very reasonably favorable tax rates. I think the Harris team would say 28% is a necessary thing to do. Trump would push back, though. He'd say, okay, tax them at 28%. They'll leave for Ireland. They'll leave for the Cayman Islands. They'll go to places that will help them shelter these taxes. And, so we don't want that either. You have to always find the harmony between these two things, the intersection of what's good for the deficit, what's good for our tax revenues, but doesn't blow people out of the seat. When Trump limited, and you're a New Yorker, so am I, when Trump limited the state and local income tax deduction to $10,000, he caused mass migration. Since 2017, we've lost over 500,000 people in New York, over 500,000 people in California, and it hasn't really helped. And I when I was talking to Trump, this is going way back December 2017, is you have to remember these port cities are economic engines for the rest of the country. People generally come in poor. Talk about people coming in legally. They come in poor. The Sergey Brins go on to create Google. The Elon Musks go on to create Tesla and SpaceX. It's one of these things where we got to be mindful of helping these people on the way through the door. So you need these social safety nets in these areas. And I think it was much smarter to have the income tax deduction. So, taxes, Andrew, whether we like it or not, they're incentives. They motivate people. You can't overtax them. They'll run. You don't want to undertax them, though, while we have all these goods and services going on.
Thank you for watching this week's recap. If you need help planning your financial future, head over to wealthion.com/free for a free, no obligation financial review. And please follow us on social media. All the links are below in the description. If you haven't done so already, please make sure to like and subscribe to our channel. And don't forget to turn on notifications so you never miss a video. Thanks again for watching. If you like this content and are looking for more ways to keep growing your investments, watch this video next. Until next time, stay informed, be empowered, and may your investments flourish.